Thank you for having me. I'm excited to be here.
Well, if we can start by getting you to paint a picture of the investment landscape, or indeed just the general landscape of America under Donald Trump.
Wow, that's a starter.
Yeah.
What I would say is,
minutes.
I don't think of it under Donald Trump. I think of the investment landscape is not that much unchanged than what it was for the last, decade or so. Certainly we have new players and new entrants in the political scene, but when you look at the businesses and the fundamentals of those businesses, there have not been any marked changes in those businesses. We are very much of the belief of a quote that Warren Buffett has been known to say, which is that markets are stronger than governments. And the idea that the market itself, the capitalist system that exists in America, is itself, it outlives all the people who come and go. And certainly, just based upon the fact that we've had 45 presidents, he's our 45th, and is an example of the market lives through these things.
I take that, but at the same time, there is a real sense of uncertainty around Trump, and that must, I guess, instinctively make you hesitant, make you more risk-averse. I mean, can you really discount Washington?
So this is what I would say. One, if you look at the market and how it's performed, that uncertainty hasn't come through in returns. Notwithstanding, I know that there was a sell-off yesterday in the U.S. or today in the U.S. But if you look really how the market has behaved over the last 9-10 months or so, there has not been any dramatic change in volatility or anything like that. So it's been relatively calm, notwithstanding all of the lack of calm around us in terms of the politics. And obviously the North Korea piece ratchets up the ante a lot, and we can get to that. But in terms of managing a portfolio, we actually have a basic belief inside of Ariel. You cannot let your politics drive your investment strategy. That's a big, big mistake. During the era of Obama, I do know of people who in our country were more conservative, and in our country, that is the Republican Party, who pulled in their horns, were concerned about the policies and the politics, and ultimately missed a spectacular bull run. And so I think it would be a big mistake for people who have those same concerns to pull in their horns about another president when, again, it's the fundamentals that are driving these businesses. And on the margin, of course, some of the things that our government does can affect outcomes like taxation and some other things. But when you look at those fundamentals, especially post-financial crisis, it's been an actually very, very good time for U.S. businesses and those businesses as they operate around the globe.
And I'll ask you about the fundamentals.
And the risk aversion, the one other thing that I want to say that, I don't believe in taking any crazy risk, but I also think, I love that quote that says the biggest risk sometimes is not taking one. I think that people get too conservative in these moments, and it costs them in a way that you cannot make up. And so, for us, we're thinking long term, and for many of the investors in the audience, they're thinking long term. And unless you're selling, unless you're locking in losses or locking in gains, you can ride out generally the ups and downs. And that's why we lead with the turtle and the patient investment strategy. Much of this is borrowed from the greatest investor of all time, Warren Buffett. We keep saying we have a guy who's alive and we can look at his playbook, and his playbook demonstrates tremendous success. So why don't more people do it? And you don't hear him talking about being risk averse. You just don't even hear words like that come out of his mouth. Instead, you hear him say, be greedy when others are fearful. Be fearful when others are greedy. Instead, you see his actions like in the financial crisis when he was doubling and tripling down on stocks like Goldman Sachs as they were falling through the floor. And ultimately, that became a spectacular return for him. So it's a different mindset that we have. Now, admittedly, that's not necessarily all investors, but it's the unique way that we think about the world in investing.
But if you look at how investors have responded, there was a Trump bump when he was initially elected, and that was largely in anticipation of regulatory reform and tax reform. And
correct.
It's proven to be unfounded.
It has not come to fruition yet. The question is, can they make it happen or not?
And what happens if it doesn't?
Well, I think, again, the market, there's no question there's the possibility of a sell-off if there were some abrupt abrupt announcement that tax reform has failed. But I also think at the same time, the market has seen the calling for 15% corporate tax rates in America, which would slash them so dramatically and increase the deficit in a major, major way, at the same time that you're giving individuals largely on the wealthier end tax breaks, which would benefit, I say with full disclosure, people like me. I think that the market is in some ways discounted that because the ballooning deficit would be very, very, very problematic. And so I'm not sure that the reaction would be as extreme, although I do believe the market is expecting something. Some of that might be repatriation of dollars from overseas, where U.S. companies obviously are holding just so much cash around the world because bringing it back is so expensive. So maybe some of that may actually happen. And we've had those tax holidays and repatriation holidays before. They're talking about doing something more sustainable. But I do think that in terms of disappointment, should this not come through, I think we've all started to see the gridlock set in. And I think the market has in some ways reflected that gridlock setting in, but it hasn't been dramatic. The regulatory is exactly the same thing. This is all harder than it looks. That's the one thing about, even as we critique or we have a point of view about anyone who leads a country of any size, it's really hard. Mm. And so I think that sophisticated investors understand these things just don't sail through.
Just a couple of questions here from the floor that are relevant to what we're talking about, particularly into Warren Buffett's markets bigger than government. If markets are
stronger than governments.
If they're stronger than governments and can withstand and outlive governments, then why did the US taxpayer bail out the market?
Well, it's interesting there. The U.S. taxpayer bailed out some financial institutions. Now, if we want to call that the market, okay. But they bailed out banks in this country. And they also the U.S. government bailed out the auto industry in our country, which I absolutely think was the right decision based upon the job losses that were at risk if Ford and Chrysler and the big three auto manufacturers in in the United States had failed. So in terms of trying to at least contain the problem, that actually was the right decision, and it actually ended up being a fantastic decision in terms of the return that the U.S. government has received on those bailouts.
But does it undermine the markets being stronger than the government?
I don't think it undermines it. I think it says that part of the issue, let's rewind history and remember where some of the sources of problems were. So one of the big sources of problems was housing. And as we know, we had this quasi-governmental agency in the United States, Fannie Mae and Freddie Mac, that had made tremendous number of loans, as well as banks had done the same, and those loans were syndicated. So in some ways, and many people, I'm not a blame placer or a finger pointer, there was a political desire to make houses available to more and more people as a fulfillment of the American dream, particularly lower income, minorities, etc. And so as a result of that, when that did occur, and this was a two-way street, so again, there's no blame here. I don't want to be misquoted in any way. There were various factors that led to the problem that we ended up having. Government was pushing that, and you have people, congressional leaders, where you can read statements of how they were trying to make this housing situation expand the home ownership in the country, and we got to some of the highest levels of home ownership that we had ever had in the United States. But we hadn't necessarily done it in a smart way in terms of making sure the affordability was there, in terms of people being able to afford the homes that they were purchasing. And then, of course, it became exacerbated with home equity loans, where you could go and take equity out of your house, and many people were using that to expand their lifestyle. So you had banks, but you had government at play here. And you may remember Fannie Mae and Freddie Mac, those were, that was near disastrous when there was the possibility of those failing. So the government went in and supported those as well. So there was government as a part of the problem in some ways, but certainly the financial institutions that had gotten way too loose in their lending standards created the problem as well. So I think is this chicken and egg? Did the government cause a problem? Was government a part of the problem? Did government then solve part of the problem that it had a hand in? I think we could debate that.
We touched
But I
earlier.
also think at the end of the day, TARP, which went in to rescue these institutions, was absolutely the right thing, because we've known time and time again, if financial institutions are sick, economies cannot survive. They can't. And there are plenty of examples that are around the world where, to the extent that those banking institutions, fail, it's very hard to pull any economy out.
If we look at the broader landscape, you mentioned North Korea before, is that what you think would be the biggest potential cause for a major wobble right now?
Well, certainly just from the potential for human life and devastation, that's something that I don't think any of us have thought about in a very long time. I was thinking very recently that in America, when I was a child, in the lower elementary grades in our country, we used to do drills around if we had a nuclear issue, where they would tell you to hide under your desk, which clearly was not going to save your life, but that is what they did. And I was thinking about the fact that I literally have not thought about that issue in any kind of material way since I was in second grade, which would have been, 7 or 8 years old, and I'm 48 years old. So the mere fact that that is now back in our lexicon, and we're actually having conversations about it, I think that in of itself is impossible in many ways for people to fathom. Nagasaki and Hiroshima are so far away from us in terms of people who weren't here when it occurred, and all we have is the visuals, which are devastating, and these bombs are so much more detrimental than those were at the time. But I do think an exogenous event like that would be extraordinary, and extraordinary in every way, including for the markets.
Even if it doesn't come to that, what we're seeing now and what we are likely to see on the weekend and what we will increasingly see until there's some sort of resolution, how much of an impact will that have on the markets, the threat, as opposed to the reality?
I think the reality, the threat, to me, continues to be muted in terms of the market reaction. The reality of something like a trade war would be disastrous. If America got into a trade war with China, you're talking serious problems around the globe because of the scale of those economies. And both economies would suffer in a very, very meaningful way, which would have follow-on effects around the world. So I would say that if that really ratcheted up to be something that that turned, if we really did, and there's obviously been a tremendous amount of what word would I use? Chatter about nationalism and closing borders and things like that. But if those conversations actually turn to something real, I think that's where we're talking serious economic impact that I'm not sure how we would even approach or recover from.
You've just come from China, as I understand. What's your reading of, before we actually look at China, what's your reading of the China-US relationship? And I mean, it seems to me that China is sort of, pulling Donald Trump's chain repeatedly over issues like North Korea, but eventually we'll be able to call his bluff.
I think it's a very complicated issue, and I would say that, that is not what I do on a day-to-day basis, which is comment or think about political relationships between countries. I'm a reader and an observer, just like everyone else in the room, in terms of what is going on in the conversation that is going back and forth. I'm hoping that, again, we will have people understand their own vested interests on both sides and ultimately lead us all to do the right thing. And I do think that China is very, very important to the United States, and the United States is very, very important to China, and that's just a fact.
And China? I know that that's not your area of expertise, but having just been there, what's your reading?
Well, I have to tell you, I was in Beijing and I was in Shanghai, and I'm on the boards of companies that have big businesses in China, like Starbucks, that has invested tremendously there, and really has created a fantastic relationship with the Chinese. Really, really fantastic. One that we're really proud of. I would say that, from my perspective of what I saw there, is you see a country continue to come into its own. You have to keep reminding yourself that it's an emerging market because it's emerging in a very, very dramatic way, and it will continue to do so. And I think that they're very resolute about that. And obviously the work ethic and everything else there is tremendous, but there's still a lot of first world experience and first world structure that still has to come to that country. And that is to be expected. But certainly when you look at the number of people who've been lifted out of poverty into the middle class, it's the greatest version of wealth creation in hundreds and hundreds of years. We've never seen anything like this, where this much change has happened in a lifetime. And so I think that that's very, very encouraging. It's interesting. One of the laws of physics says an object at rest stays at rest, and an object in motion stays in motion. And I think they're an object in motion. And I think they will continue to stay in motion. I think the one thing for us in America that we have to understand about that object being in motion, that this does not have to be a zero-sum game. If the pie keeps growing around the world, that means it's bigger for all of us. So your one slice of a bigger pie is probably better than even a big slice of a smaller pie. And I think that's something that is a very simplistic take, but it's one that is sometimes missed in some of this rhetoric.
What about the impact on markets and the investment landscape of trade deals, the rewriting of trade deals, the threatening, even with South Korea, which I find extraordinary given what's going on with North Korea? Of course, the pull out of the TPP. Is that going to have some serious ramifications?
It's really interesting because this is now, I have no special information, but this reading it is a bit of a head scratcher, especially the South Korea piece. Because interestingly, when you look back a few months ago when there was a conversation about was America going to go out of the TPP, and was there tension between America and China in terms of our trade, you may remember that our president said, well, if they help us on Korea, I'm willing to rethink that, which I thought was, okay, logical. It wasn't the strangest concept. So interestingly, right now, when the Korea situation has escalated in such a way that don't think any of us ever anticipated, the idea that we'd actually be having this conversation about South Korea and trade right now, that one for me, I don't quite understand. It seems like alliances right now need to be really, really tight so that we make sure we send a very clear signal that there's no light between the shoulders of the world around this issue of nuclear proliferation in North Korea, because of the danger that is there for all of us. Not just South Korea, not just China, but not just Japan, not Guam. I mean, the whole world is at stake in that kind of arms race.
So what's your advice to people in the room in terms of looking at the US market? You've talked a bit about how to look at it, and it's very much a long-term approach, if you like, and not being carried away with whatever Donald Trump has tweeted. But what's the advice about where to focus?
Well, I think it's not only being not carried away by whatever he's tweeted. I think you have to actually tune some of this out. I'm encouraging our investors, you've got to just tune out the noise, because the noise is not necessarily logical. There isn't a logic to this where you could say, okay, if this, then this, because things change on a dime. And so to try to react to that is dangerous. What you're asking yourself is, what is going on with individual companies? And this is what I would say when I think about America in the most humble way. I want to underscore this, because this is not an American exceptionalism comment. This is a comment that I truly do believe with humility. We can't guarantee what is going to happen, but I would say I would not bet against us. And so I think that in the best of ways, and I wouldn't have bet against our economy, and I wouldn't have bet against our companies, because I think over the long term, even when we've come up against incredible difficulties, we have been smart enough to figure out how to overcome them. And again, that's very much of the Buffett theme. That's true of when you even look at great companies. Great companies survive bad leaders. They really do. If you have a really good product or a really good service, generally it will survive a leader that is not great.
Might have a very nasty time in the interim, though.
That's correct, but it does not mean that that's forever. So that's the big question. That's the point about the long-term view. And that maybe is where, and I say this with great respect, that China might have a little bit of edge on the world, that they think in quarter centuries. They think in 50-year periods.
They don't have quarterly reports to a whole lot of investors.
And that is a real luxury. That is a really smart thing to do. If more people do that, I mean, we've gone from quarterly, which I think is horrific. Warren used to say there's nothing magical about the sun circling the earth in terms of investment return, when we look at 1-year returns and 2-year returns, and certainly we believe that in the short term anything can happen, but over the long term skill wins out. Luck sort of falls away, but skill or real talent or real quality wins out over the long term versus short term. And we've seen that so many times with fads that come and go versus companies that can stand the test of time. And that doesn't mean that those companies are old. They have an idea or a fundamental to them that's very, very great. But I do think that, as we've all, as investors, in many ways have become, just because of news and information and the internet, that we are living minute to minute. And we're not even living, quarter to quarter. We have clients who are asking for monthly information. And we're a long-term manager that owns our average stock for 5 years. And sometimes we have nothing to say. Nothing happened in a month, let alone, those who are looking at this on a daily basis. I think that it's leading us to make decisions that are not in our own best interest. At Ariel, we tell people we play time arbitrage. We're able to take advantage of the short-term nature of others because our long-term view gives us that perspective that we can use that time in our favor. And using that time in our favor, we believe, augments the return that we can deliver to our customers.
I've got a question from the floor here, which I'll just give you the question and then we can discuss it. But it says, normally markets drive politics. However, these are times when politics drives markets. Clearly, we're in one of those times. Is populism here to stay? Now, I know that sort of goes against what you've been saying, but I'm interested in a conversation we had earlier. You made the point, if you're talking about politics driving markets or markets driving politics, if you look at the reaction of company share prices when Trump first came in and he would mention a company name to now, how much has that changed?
Dramatically. So they actually used to be the fear of the Trump tweet, that would they target your company? It's interesting, the most recent example of this is Ken Frazier, the CEO of Merck. And many people know that he was the first to drop off of the Business Council, the Business and Manufacturing Council. I can't remember the exact name of it. And I know him, and there were a lot of stories that were written about it at the time, and I know his lead director, and they talked about that. And think about this, this was in reaction to the comments in Charlottesville about there were good people amongst the white supremacists, and Ken is one of the very few black CEOs in the United States, but he happens to be the CEO of one of the largest pharmaceutical companies in the world. And so ultimately he went to his board and said, I cannot stay. Now, it was interesting because you have to think about that in terms of he's making a decision that's personal, but one that could affect their company and affect shareholder value. So he's opening them up to some possible problems, maybe, I don't even know, lawsuits, I don't know. And ultimately he decided he had to go. So he announces that he's leaving the council and the stock rallies. Merck rallied on the news. And I thought that was really fascinating because we hadn't seen that sort of thing happen before. And so I think that in and of itself made a very clear statement. And I think that also made leaders more comfortable with now speaking out. Now, obviously you had Bob Iger, who had dropped off of the council before that because of dropping out of the Paris Accord, and you had Elon Musk, Bob Iger, the CEO of Disney, Elon Musk, the CEO of Tesla, had dropped out, and they had done that weeks before. But now, after Ken Frazier dropped out and comments were made about he was just gouging his customers and some other things, the market just didn't even react. It walked it off. So, I think that's the good and bad of this situation. The good of it is that perhaps we've been able to get ourselves out of the drama of this as it relates to individual stocks. And I say perhaps because we know with the stock market, anything can happen. I think the bad of it is that you end up having a situation where our leader says things that are just discounted. And that has its own implications and repercussions that, could be detrimental to our country in other ways.
Just before I open this up to the floor, I just want to explore another issue that I know concerns you greatly, and that is the huge growth in passive owners, massive passive, as they say. What are some of the more concerning implications of that? And is it really a case that passive investors are truly passive? Because they may not be able to vote with their feet, but they can certainly name and shame and, throw a hell of a tantrum.
Well, here's the implication that I've been talking about that I have not read in a lot of places, which is that with the tremendous flows that we've had to passive, and they have been tremendous. I mean, I was looking at things like BlackRock, they crossed $5 trillion last year. I looked at, they'd taken in an average over a decade of $400 billion a year in new assets. If you look at Vanguard, which is ground zero for passive investments, really starting with Jack Bogle's Princeton senior thesis, and how they developed that company, that 6 of the top 10 mutual funds in the United States are Vanguard passive funds. 6 of the top 10. The largest active fund is rated number 5. So, when you really think about, what they are doing, there is, we've seen a tremendous inflow. So the inflows have been very strong. Their performance, they've outperformed active managers in recent years, and I'm going to qualify that because a lot of the data we look at for active versus passive is the last decade, which has been a bull market. And if you look at that data over longer periods of time, which has been done, looking at 25 and 30 years of active versus passive, you get a draw. Half the time active wins, half the time passive wins. And that is not in the conversation. So we have what we would call a recency effect going on into behavioral finance, in that the recent has anchored us to what we believe will happen in the future. But the big issue that I've been thinking a lot about is, to the extent passive gets to be so big, less shares are held by active managers, as we know. And that gives a different voice to an activist, because the passive investors are captive. I read an article where someone said they're in a car that they can't get out of. There's nowhere they can go. If it's in the benchmark, they must own it. And so for the active voice, the activist that is working against those names, they end up with, even with fewer shares, a lot of power, potentially. It also just begs the question about the power of the passive investor. And I have still not been able to really get to the bottom of the answers. Obviously the proxy voting is, in the United States, we can see how the proxies get voted, et cetera. And there is more dissension once the proxy voting became transparent than there had been in terms of voting against management. But the issue for me is, you've got these passive investors that are, even if they vote against, they're not going anywhere. It's just the company, the repercussion, maybe the vote against, maybe the company loses, maybe they don't, but they don't vote with their feet in any way.
But wouldn't it be a very brave company? If I think in the Australian landscape, if you had a major bank and they had a REM report that was voted against, it would be a very brave company that turned around and said, well, I know the vote went that way, but we don't care because you have to hold us. I mean, they have to respond to shareholders, even if the shareholders can't walk away. They make a loud enough noise. It would be
that's the question. I mean, honestly, we haven't really tested that thesis yet. And so that's my big question. If they're not going anywhere, they voted against, maybe you lose the vote. It depends on what the issue is, obviously. But I do think that we haven't had someone put a really loud public stake in the ground on this issue on the passive side. And I'm waiting. I assume that day of reckoning will come, but it'll be very, very interesting to see when it does come what happens. The other thing that I found interesting was that I learned from some of the activists is that the passive shareholders vote their proxies last. In the United States, they vote at the end. And one of the activist investors said to me, the issue with that is we actually don't know where they stand. So we might be in conversations with them, but they may or may not reveal what their plans are. They haven't voted until the end. And so we might go down a path of activism that we literally cannot win. And if we had known on the front end, it may have changed our strategy. So it's just, if you wonder why they vote last, as another thing, and I think there's some nuance here that just we've never seen before. And I just wonder how that nuance will play out. I mean, they say that, and don't quote me on the exact number, but it's something like Vanguard Group right now owns 5% of more than 400 companies in the S&P 500. They have enormous power and influence. And if they decided, especially on certain issues, that they wanted to take a stand, it would be a game changer in the world. Just not America, not just U.S. companies, in the world. And so you wonder, with that power, ultimately, what could happen there?
It's also really interesting that just the sheer shrinking in the number of listed corporates that you can be active about. I mean, if you look at the numbers in 1996, there were 8,000 plus companies that were listed, and last year there were less than 4,500.
And a big part of that is because of private equity. So the growth of the private equity industry, which has been tremendous, has taken those companies private, and so there's that shadow market that is going on alongside of the public equity market, which is they're still companies, they're still out there, they're just not held in public hands because of that. But I do think that that's a very, very fair characterization. Now, what I would tell you, and what we believe at Ariel, that this move towards passive creates tremendous opportunity for truly active managers. Because if you're truly active and you are truly contrarian, some of these stocks that are not in the indices, they've just been orphaned. So they're selling at really great valuations because the passive trade is a crowded trade. And so to the extent, it's interesting to us, our portfolios are selling at really compelling valuations despite the fact that we've had this very strong bull run. But we think a lot of that has to do with the inflow into passive. The other thing that is interesting that a lot of people don't think about, you need active and passive together for the market to have equilibrium. It is necessary, and even Jack Bogle says that. Even Vanguard has active funds. And so the idea that active has been criminalized, or this idea that if you're paying up, if you're getting returns, that paying up may make sense. And I'm not saying you should pay a lot. I'm just saying whatever a fair price is. And so this equilibrium is necessary because to the extent the whole world goes passive, you're going to have a tremendous number of mispriced stocks that are out there. And to the extent the whole world goes active, the market becomes extraordinarily efficient, which creates the opportunity for passive. So this pendulum swinging very far towards passive, in our view, although painful for managers like us who are seeing asset flows go out of active, it actually, in a very strange way, creates more opportunity to outperform.
I get that. Questions from the floor? I do have lots of questions that you submitted through the app, but does anyone actually want to ask one physically? No? Well, I'll come back to you in a minute. I'll just start reading through some of these. If governments are going to bail out industries where there may be job losses, for example, US autos, where does this stop? The government will be bailing out every industry.
Well, it's interesting. I think that was a scale issue. That was a very, you were talking about the auto industry and the related suppliers represented, I've heard the number 2.5 to 3 million jobs in the United States. And so from that scale perspective, and I get this whole moral hazard argument, I've thought a lot about it, I understand it, but if you looked at one, the job losses that were going to occur had that bailout not occurred, and two, the fact that it worked. The U.S. government made a lot of money in terms of a return on that investment. And so I don't think that this is every industry. I don't think this is being willy-nilly, and I don't think the government should step in on a day-to-day basis. I think this was an extraordinary once-in-a-generation scenario that I hope in my lifetime I do not see again, or any of us will see again. But to the extent that that happens, and it's interesting, some of our most conservative leaders in the United States were the ones proposing it. So Hank Paulson at the time was Treasury Secretary, former Goldman Sachs executive, the one who did speak a lot about the moral hazard at the time, but he was the one literally grabbing Congress by the lapel saying, we need this money, or the whole system is not going to work. So again, this is extreme situations. I would not do this this is not something that should happen regularly, and hopefully maybe not ever. But if it were to happen again, I wouldn't want to stand on ceremony and say, that is just a hard line that we do not cross, because we could all be lost. I always love this quote. We read this book during the financial crisis at Ariel that I recommend as one of my favorite books. It's actually not about the investment business. It's called Deep Survival, and it's by a guy named Lawrence Gonzalez. And the subtitle to it is Who Lives, Who Dies, and Why? And specifically, he looked at disasters that happen to people and that happen around the world. Again, not financial crisis, but everything from airplanes crashing to all sorts of things. And he said, what leads someone to survive? Why do they survive? And he gives these examples that are unbelievable. Like he talks about the fact that if you have a 5-year-old child and you have a 10-year-old child and they get lost in the wilderness, the 5-year-old lives. And the 5-year-old generally lives because the 5-year-old has no context. So if they're sleepy, they lay down. If they're thirsty and the water is muddy, they still drink it. The 10-year-old thinks dirty water and dies of dehydration, or thinks I can't sleep because I don't know what's around me and dies of exhaustion. He gives an example of a girl who is on a plane in Latin America and the plane crashes and she lands in her seat in the middle of the jungle with a few other survivors. And the survivors say, we're going to stay and wait for help. And she says, I'm out of here, 14 years old. And her father always taught her, follow water. If you're ever lost, look for water and follow it. She looked for water and followed it. She was in her high school, Catholic school uniform and high heel shoes, walking through rivers with piranha, all sorts of things. But she lived and everyone else died. And the point being, survivors rescue themselves. They don't ever wait to be rescued. Now, why do I give this example? Because there was a point in it that I took back to my team and said, we should remember this. They talked about the military, and they said one of the things about the military is, and they used this quote, rigid people are dangerous people. When you have a very rigid military leader who's not willing to adapt to new information, they kill their entire troop. And so this rigid people being dangerous people is something that I have never let leave my mind. And so when we get rigid about rules, and we even have that Ariel, we talk about when we're debating names that are going to go in the portfolio, and people can have very strong opinions, we always say, hold your idea lightly. Don't hold it dearly. Because you hold it dearly, you start feeling you have to justify it. But if you hold it lightly, you give yourself the flexibility to change your mind. So on something like a bailout, I would hate to have hard lines. Because if we had had that hard line, we would have all been lost.
It sounds like an approach to an entire investment strategy, if you like. Another question here, that if markets are stronger or outlive governments, what are the market issues, and more importantly, the opportunities? So, it's an interesting question. The opportunities one, but also what is at the forefront of your mind? And not North Korea or issues like that, but in a very realistic day-to-day way.
Well, I think one real issue that has been in our political discussion as well is regulation. And I think that's true around the world. And so that regulatory issue is something that I think can stunt growth and can keep companies from realizing all the value that is possible. And some of that comes from the regulation being well-intentioned, but not necessarily thinking through all of the ramifications. And some of that can be regulation where it's a reaction to what happened, and it's not necessarily in the best interest of the long term. And we've all seen those things happen. I mean, we are regulated in our industry in America, and we have a number of regulators, the Department of Labor, we have the SEC, and there are times that they have rules that I can say, again, with humility, that we'd say, that is a rule that came from someone who actually doesn't do this. That if you did this every single day, it wouldn't necessarily make sense to you. But it's the rule and we must follow it. And so these are challenging ideas, but the regulation can be, and it also begets regulation, it seems to me. Because you have regulation that's established inside countries and then others react to it. And so it creates, in some ways, it can be an arms race around regulatory. And that can be truly stifling. Now, I believe in rules, and I think that, a lot of what has made all of our societies work is the rules and regulatory infrastructure that is in place. And that's everything from how this room got built, that it is stable and none of us thinks the ceiling is going to fall in, to it's how the financial markets are set up in terms of I have to be a licensed investment professional to give investment advice. Just like people have to be doctors or you have to be lawyers and pass the bar in the United States. So those things to me make sense. But sometimes we go too far, and that regulation, when it's overdone, can truly threaten the long-term viability of an economy.
Any questions from the floor? Just checking. No? Oh, yes, we do. We have one down the back there.
Thank you, Mellody. You're always inspirational to listen to. I do have a question, though, around your comment around China and how fabulous it's all growing.
I didn't say fabulous. I just said that when you look at, the body in motion stays in motion. I didn't say fabulous. Obviously, their growth rates have come down, but their growth rates, we'd love 6.5% or 7% in America, GDP growth. We'd love that.
Yeah, absolutely. My concern, though, is that it's based primarily on exploitative labour practices, and when we invest, we have an obligation to ESG factors, and I wonder how you could respond to that. So,
I can only come from my perspective of what I've seen from U.S. companies and their behavior inside of China, and I think we've brought some really great labor practices to the country. I am not an expert on Chinese labor practices, and I do not want to pretend to be one. I'm looking at the numbers of people who've come out of poverty and saying that is a very, very good thing. I have a friend who always says math has no opinion. That math is very compelling. The tens of millions of people who are living a better life today than they used to live. But when you get to specific practices or policies, I will be the first to acknowledge I am not an expert, so I do not want to present something in a way that is ill-informed, because I do not know.
Now, the other question down the back there.
Thank you. Sometimes I find it's very difficult to know what to trust and who to trust these days, because of the sort of the massive growth, supposedly, of fake news. And probably that's been driving some political elections and opinions in the UK, in Europe, in the US. And, you read about, is Fox News a media channel or simply social propaganda? So I just wonder if you had any comments on the impact of fake news on US politics, US public opinion, and I guess down the road then US markets.
Well, I can tell you it's disturbing. So when you see some of the real fake news stories that have been out there, I mean, some of these things are so crazy that you just can't believe that they actually take on a life of their own. Often, there was a day when in the media, you would never quote another media. Today we're very used to seeing, as reported on ABC, Mellody, Hobson said this, that, or the other, from another media outlet. That was like taboo. You did your own research. And that just isn't the case anymore. And that leads to things that are not true being repeated. It underscores our need for, I think, children to really get very, very strong training inside of school around ethics and around, in many ways, what used to happen a long time ago, verifying information as opposed to just believing it because it's been read. But I have to tell you, some of these stories, I mean, if we look at just a really basic one that existed for 8 years, that Barack Obama was not born in the United States, there is a significant number of people, there was a significant number of people, I'm talking tens of millions of people who believe that to be true, despite all of the evidence to the contrary, because it was just repeated over and over and over again. And I remember being with a friend's grandmother who was like, this nice little old lady, and literally said to me, well, Barack Obama wasn't born in America. And I was like, oh my goodness. This was, a learned person. So I think the danger is serious, and I'm glad to see organizations like Facebook and others say that they have to now think about this and deal with it in a very different way. But what they're trying to do is extraordinarily hard, because there are not a lot of algorithms around these issues that are easily, you have to really work hard at how are you going to find it when you think of the vastness of the information that is out there. I thought it was tremendous what France did in planting all those stories to try to throw off some of the efforts to undermine their election. So on the one hand, I mean, it's and barraging the media with information that they couldn't tell the difference between from what I read. But I think it's a real problem, huge, and we've seen it in America. I mean, I looked at stories that said things like the Pope endorsed Donald Trump. And it was like a story that was like written in totality. And I was like, first of all, the Pope doesn't endorse anyone. But it was written in such a way that, I could see how a person who was not aware that the Pope never makes endorsements would have read that and maybe thought that it was true.
Look, we are out of time, but I just want to finish by very, very quickly making you sit in a crystal ball just for a minute. Biggest investment opportunity of 2018?
I don't think in 6 months, periods. I mean, that's not what we do at Ariel. We would be thinking over the long term.
Okay,
and I think one of the biggest areas that creates the biggest opportunity in the world, I think one of them is healthcare, because of the aging of the global population in certain developed markets. And that is going to lead to more needs of healthcare. So that's one of them.
Healthcare good? What's bad? What do you steer clear of?
In our international and global portfolios right now, we've been underweight in banks. We've been concerned about the fact that we don't necessarily think we're getting paid for the risk that is being taken there. We're a little concerned about some of the practices and how banks have loosened up a bit in terms of their lending practices, et cetera. The other place I would tell you that we think long-term has a lot of potential is telecom. Because again, the one thing I keep saying about telecom, people will not give up their phones. If they will not give up their phone. If they were getting evicted, they still understand they need a phone. And you're seeing that in a lot of places in the world. The phone has become, it's a lifeline, even more than a house or more than food and shelter in certain situations, because people recognize you cannot do anything without it. The one last thing I would say that we're looking at is we think there's real potential, and this is counterintuitive for a lot of people, for investments in companies that can lower prices as opposed to raise them. So a lot of time when we talk about companies, people talk about pricing power, but we've actually been thinking about, because of the massive growth of the emerging markets, to the extent that you can keep bringing prices down, you have the ability to create that scale that leads to greater profitability. And it'll be interesting to see how that works. Now, some companies have been completely against it, like Apple. So Apple's coming out with what, $1,000 phone, $1,000 US, and they have not played the cheap phone market. So, they've gone on one extreme, and we've seen maybe high-end retail be the same way. But when you think about some of the other things in telecom, like how much cheaper data is today than it used to be 5 years ago or 10 years ago, or what we're seeing now with the unbundling and cable, how people want cheaper. If you can make things cheaper, we think that will lead to long-term success as a big investment idea for, the next decade or so.
And very last question, will Donald Trump survive the term?
You tell me.
Well, certainly my opinion does not count. But look, can you please join me in thanking Mellody Hobson very much for her
Thank you very much.
insights.
Thank you for having me.
Thank you, Mellody.